Hi, this is the next in a series of acquiring business financing as part of the Lean Finance series. And what we want to talk about today is bank financing. Realize that commercial banks, the traditional FDIC insured banks, are still the largest financier for growing and small businesses. The issue is that most of the financing comes in later stages, and startups have little access to bank debt financing. Why that is, of course, is that typically startups don't have any collateral in the form of physical assets like receivables, inventory, or manufacturing equipment, or property, or buildings. Also, there's a lack of earnings or cash flow history, which two things banks really have to examine when they provide loans. Now realize when you go to a bank for financing, you have to be both a buyer and a seller, because when you go to the bank, you're basically buying capital from them. So you have to be concerned about the terms that you're going to pay back, the interest rates, how long is it going to be paid back, what are the covenants, and so on. But also, you have to sell the bank on the concept that your business has the ability to repay. So there's a combination of you're both looking at things as a buyer of capital, but also you have to be a seller to convince the bank to provide you the money. Now, in the U.S., of course, there's the Small Business Administration federal program, which provides a significant amount of guaranteeing of loans, just like the Guaranteed Student Loan Program, where the government doesn't lend the money, but they guarantee the loans to the banks. And that's a great source to look at for potential financing for small business. In Wisconsin, of course, there's a ton of SBA-approved banks, but realize, especially from the startup standpoint, that most Wisconsin banks are very conservative. They will almost demand or require collateral, and will less likely will probably not loan solely based on your ability your cash flow ability of your company. Remember, when bankers are looking at a company, they're looking at what the old traditional 5 C's. They're looking at the cash flow of the company, as we briefly mentioned. One of the things they'll look at is your debt service ratio. We'll talk about that in a second. They'll look at the collateral that the company has, its ability that the collateral will maintain value, that it's not secured, nobody else has an interest in it, and so on. They'll look at your debt to equity mix, or the amount of capital in business. Usually they're not going to want the debt level to be more than 2 or 3 times the equity level. Fourth, they'll look at the character of the entrepreneur and the management team. Some people underplay that, but I think that's very key. And then 5, they'll look at the conditions, the overall economic and macro environment conditions, not just the economy, but also the industries that the company will be competing in. Now, this debt service ratio is something a lot of entrepreneurs aren't real familiar with. And really, all it is looking at the EBIT, or the operating profit of the company, and divided by the interest expense for the year plus principal divided by 1 minus the tax rate. What this is and you can see an example here, it's a ratio that provides banks with a semblance of, okay, what are the operating profits in relation to paying back the principal and the interest. Now, there's a lot of different ratios, what are good ratios that are used. Usually banks are looking at 1.5. They want to see a debt service ratio of 1.5 or 2 or higher, so that they feel safety in that the loan they provided you can be repaid, but also any future capital can be repaid.